So plus we'll be able to get some more questions in. What do you think? Does that sound fun? I'm kind of more into that. Why not, right? Let's whiteboard it. So it's kind of like what I did before. Almost all of my presentation stuff's available out there. So why not, right? But I'm still going to pull over some of the other stuff and let's see how it goes. So for anyone who doesn't know me, hi. My name's Thor Young. I'm a moderator at Bear Bull Traders. I've been a professional stock trader for, 4 years. I've been a moderator at Bear Bull Traders for about 3. And I love day trading. It's a really fun gig. I've really found just this really fun world here to kind of dive inside of, and it's been a lot of fun to get used to. As we go through this presentation, we're gonna talk about some different concepts. Mainly, I want to talk to you guys, especially since this is like a little bit more of an advanced group. I really want to like dive into some concepts around value and making sure we're getting the right concepts of value and range. I think the main thing that is going to help y'all, right, is always thinking about those aspects, value and range. So now value, right, is very, very specific, right? Value is tick, right? Value is a tick. So as the stock price goes up and down, every time the bid and the ask become one, we have a transaction occur, and that transaction is price, right? Price is value, but price changes, and it changes over and over again all the time, right? So as we tick up and we tick down, right, price starts to congregate at certain areas over and over and over again. And those areas that congregate more specifically will give us what we use as like a VPOC, right? Or a volume point of control. This is going to be our greater perception of value to the market as a whole, right? So what we're seeing here is you're not just seeing where individual prices, but where are large quantities of transactions being exchanged over and over again. This isn't even really about like big players versus small players versus all of this. This is just about value, right? A lot of you may or may not know, right, that I'm a little bit country, right? So I grew up in North Texas, kind of a little south of Oklahoma. My family has a hog farm out there. It's still there. It's been in the family for generations, and my family have been in that area since before it was settled. I actually have Choctaw Indian lineage on my father's side that goes back, so I quite literally have lineage into that area for longer than recordable. But since growing up in that area, one thing that's always been really consistent is when you're out there and kind of like the farmland and all that, you go to auctions a lot. And I used to spend tons of times in auctions, and it wasn't really just about figuring out what people would pay for in the moment. It was just about figuring out what something's worth overall, right? And that's really what this is what is the broader market perceiving as value. Now, why is it so important to understand where the market is going to perceive value at, right? Like why can't we just ABCD pattern, right? What does it matter what value is? Why can't I just ABCD? Right? Why can't I just do these things? Why do I even need to consider these things? Right? Well, the reason is because patterns are reflections of price action, right? Price action is not a reflection of patterns, right? So you can have moments like where someone may say something like, hey, really thought the market was going to do something different today, so I had a bad day and I ended up stopping out a lot. And then your question in that moment needs to be, why did you think the market was going to go a different way? Like, that's very assumptive. You know, do you really like feel like you have a good enough understanding of like general market dynamic and all of these things to be able to make a prediction of which way you expect the entire market to go that day? Nah, not really, right? I would say more likely what's going to happen is you're going to be able to play the market as it's in a range, but we really have no idea where it's going, when it's going to go there, right? That's why value is important. That's why understanding the system and the process that's in place, which is what we cover here, is important, right? Because if you're trading off the ladder, you're trading off of what has happened, right? Hoping that because it has happened, it will happen again. And for me, I found zero value in that over long term, right? Because when we play stocks, we generically play them when they're in catalyst, which means we kind of expect them to do what they didn't do before, right? Because they're in catalyst, they're breaking out. Because something is happening, they're doing something new. Their R-vol is unusually high. You know, that something is going on. And this is why we find these stocks. So expecting the stocks to adhere to levels that existed a long time ago, will they influence? Maybe, right? But it's not actionable, right? So the first thing we're going to do is with value, right, is we need to understand that value is going to give us the best ability to predict where we're going and how we're getting there and how well of a job we're doing. Camarilla pivots are nothing more than a calculated measurement of value extension, right? So this is kind of how I've been showing this a little bit lately. Let's go black here. Any questions or comments, feel free to throw them in there. Otherwise, I'll just keep on presenting as if you guys are just riveted by what I'm saying. So each one of these areas, imagine this visually as a VPOC, right? As a high value area, right, that is established up in these areas. As our price trades, the stock market is nothing more than an auction that is moving between areas of high value. We like to really complicate it, right? We like to always make things like super. Now, there is a system here, and that system itself is kind of complicated, but what drives the system is not. Thank you, Ian. What drives the system is the same thing that drives a good old cattle auction like the ones I went to as a kid, right? Which is that we are going to be trading, and as we're trading, right, the stock market is going to move from one value area to the next, and then back to the next value area, down to this one, and then back up. And we're going to do that over and over and over again until eventually we don't. Right? Now, each one of these can get increasingly smaller as you draw down, right? So now this is a high value area here, but you could actually break this area down into, let's see if we can make this look interesting. Let's imagine a magnifying glass, right? And that magnifying glass is looking inside of this value area, right? Inside of that value area are also smaller areas of value within that. And the same way that price was moving this way, price is also going to be moving inside of this value area as well. And this same value pattern happens over and over again at each one of these various levels. So the reason we have Camarilla pivot points is because what we want to do to increase our ability or our odds to get really, really good trades is we want it, rather than trying to play inside of value, we want to play when we're away from value, getting sucked back in, right? So if you're looking at this now, imagine the chart would look like this. Hold on, let's use, yeah, we'll keep with the pink just so it's consistent, right? A chart's going to look like this. Right? As it moves up through these value areas, right? This is what our chart is going to end up looking like, right? So the reason why we're looking at these cams and these extensions of value is because what you don't want to do is you don't want to play. Let's get a new color. You don't want to play in these areas here. These areas immediately around value are what we call kill zones, right? Thank you, Tracy. Exactly. These are what we call kill zones, right? We don't want to trade around these areas because these areas are high value. So we expect the market maker to stay here for a long time and work, right? We want to take the trade when the trade transitions from one value area to the next and from the next to the next. And ideally, we'll buy here for the trip all the way up to sell here. And then we short here for the trip all the way down to buy here. Right? So, and on the chart, that looks like a long after the double bottom for a trip up to a stop out after we lose the moving average cross, right? Or to the, and then re-shorting at the test and the loss of the head and shoulders, right, as we take the trip back down. But the areas we, again, want to avoid, right, is we want to avoid these areas here, right? You're going to want to trade this area to here, smaller but doable, right? Or you're going to want to trade from this area up in. Right? But you never want to trade in here because you're always going to get chopped out. And this is where our cams come in. Once you start to look out over time, what you'll notice is our cams are going to line up like this. That last one didn't go so well. Right? Our cams are going to line up like this. Right? So that we're going, so that your third zones, right, are where we're buying and selling for our inside traverses, and our fourth zones are for our insides or our breakouts. Right? So I wanted to go through that and hit that for a second to give you guys a little bit of an introduction on the whole grand scheme of things. All right. So how we're going through. So now that we got that, I'm going to go ahead and hit up some of the slides because I want to talk to you a little bit about the information that's in there just so you guys have it. And then we'll go back into a few other things here at the end. Let's see here. All right. So the first thing, let's see here. All right. So the first thing I want to talk about, just for some general knowledge, because I always think it's important to get a little extra general knowledge about it, is actually where Camarilla comes from. Camarilla, the word definition, Camarilla, it comes from, it's actually another name for a group of confidential, often scheming advisors or a cabal, right? Back in the day when this came out, everyone was thinking that, you know, there was some secret elite group that was controlling everything, and they really couldn't gravitate, you know, to the concept that maybe, just maybe, it was a market auction and this stuff was just kind of crazily random. So now you get this really big quote here, and this quote's really funny because it comes from a guy named Nick Scott. As most of you know, I'm writing a book right now, or actually I've written a book and it's in editing right now. And Camarilla pivot points were actually in my research. I discovered they were not actually discovered by Nick Scott in '89, who is a bond trader who claimed them. They were actually discovered by a brilliant student from Montreal named Mitchell Kurtzentwig. MB actually discovered Camarilla pivot points after he did a really intense collegiate study on the futures market. So the reason why Camarilla pivots work so well is because they were actually designed to be used with the S&P futures, right? So this is part of the reasons why, these tend to work so well, and why they have worked so well since is because they directly correlate with something that really steers the market quite a bit, right? So, but it was really interesting that, this gentleman was taking credit for those. But what inevitably happened is, Kurtzentwig sold a few copies of a small book that he made to a couple of firms, and eventually his calculations got leaked out, which was too bad because he was making a lot of money off of a black box algo up until that happened. So these are the calculations for them. If you want to get them in DOS, they're included in there already. I wouldn't say they're 100% necessary. However, if you're doing an S4 breakout, which happens all the time, S6 is where you're going to be looking to go. So, for my strategies, I use them almost, daily. So, I would, but they're not really necessary for taking trades, but they're good for trade management. But if you have DOS, they should be already available in your config. If you don't have DOS, I'm not sure, because I've only used DOS for trading. In DOS, if you want to add them, this is how you do it. This is what the config at X looks like in DOS. So you will have that available. But you can see here, S6 and R6 are just right down here at the bottoms. If you have DOS and those aren't checkmarked, then what I'd recommend doing is checking the version of your DOS. There's a potential that your DOS may be out of date, and maybe that's the reason you don't have those. But they were added about 5 or 6 releases ago, so I wouldn't think so, but it's possible. Dash, yes, I believe it is. So when I trade with pivot points, I color code my pivot points. The third line and the fourth line here are green because they indicate more of a buying zone, breakouts. Fourth lines are also for reversals as well. So, the color codes aren't like rules. They're just nice to have. Our red pivots are going to be for shorting. So short at the top of the range are shorting the breakdown here. But like I said, you can see off this S4, see how we did a reversal off of it, right? So we play extreme reversals off of S4 as well. But again, nice to have colors. Oh, nice, James K. Excellent. So the next main thing, or one of the most important parts of getting used to this system is being able to differentiate inside day versus outside day. Now, the main thing that Camarilla pivot points bring to the table is what's called aware. Whenever you're trading, and this is whether you use cams or not, hear me out on this one. Whether you're trading my system, your system, any Eamon system, Mike's system, John's system, Dima's system, whatever, you need to make sure that whatever system you have has 3 components, because you cannot evaluate your trades without them. I mean, you can, but it's I don't know if pointless is the right word, but whatever. You need to make sure that your trade has a where, a when, and a how. And I know that sounds really basic, but you have no idea how often, especially newer traders, are trading without one of these components. And all 3 of them are vital. Some are more vital than you think. A lot of people put very, very little focus on the how, which is how you trade, right? So that's how you get in, how you get out, right? How you manage the trade. But yet people will not put time into that. They'll spend tons of time trying to figure out where to take a trade, but they put very little time into how to manage it, right? So you need to have all three of these items precisely detailed and figured out on how you want to do. What Camarillas give you is this. They give you a where. And that's one of the greatest things you can have, right, is something that makes you wait, right? Camarillas will make you wait till you get to a proper where, right? So think about this, the trade I showed you guys at the beginning of the day. I'll show you at the end of again when I took it short on Oxy off of R4, right? I waited for the stock to get above R4 and then I took it short, right? My where was R4, right? I only evaluated it because I was outside of R4, right? The win was when the volume spiked and the level 2 imbalance to the downside. That was my win. But I still didn't take the trade because even a win is not a trigger. The trigger happens in the how. Right? So now that I know I want to take the trade and it is time to take the trade, I still need to be able to take the trade. And this sometimes stops you from taking a trade, even though it's a good trade that is set up for you because it's in a bad position or because the RVR isn't good enough for you to take the entry. You have no how, right? You have no risk management. So like mine is normally I'll play a new 1 minute low using a new 5 minute high. Right? Or a new 1 minute low using a new 1 minute high if I'm really certain and being super aggressive, right? But that's my how I get into the trade, right? So you got to have each individual one of these components for every single trade you take into. Anything else, gambling, right? Anything else, gambling, right? If you're getting into a trade, an ABCD pattern without any signal, without using any volume, or anything, you're just buying the new high, it's gambling. I mean, not that you can't be successful, but flip the coin, right? There's no reason to think that stock's going to go any further up just by watching it make a new high over a new 1 minute or a new 5 minute. There's nothing to suggest the stock's going to keep going. If anything, what's going to happen is you're going to get trapped buying it, right? You need to have the proper level 2. You need to have proper volume. You need to have, a lot of different things going on, letting you know that, hey, the market is working here. Things are going well. I'm going to put my money in this thing and get it. You've had a hard time waiting for the flip of level 2. Yeah, that it's hard, right? So Ian, here's an analogy I want to toss at you, right? I'm going a little off script on this one, but we talked about this a little bit at my last Thursday mentoring session with a fellow trader. So, and the analogy, I don't know if you were a part of any of that or heard it. It's what I'm calling the cheetah analogy, right? So, and this works whether you're scalping, trending, or whatever. But as a stock trader, you need to think more like the cheetah, right? So a lot of us, when we're stock trading, we think high frequency. We think, I need to take a trade. It works. 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 And it's just, oh, it doesn't work. It doesn't work. It works. It doesn't work. It doesn't work. It's 10 trades, 15 trades, 20 trades. I take one trade a day, right? Maybe 2 trades, 3 trades a day. If I've hit 5 or 6 trades in that day, I'm either having a lot of fun that day, but most likely I've struggled, right? And I've had a lot of trades because I've struggled with patience, and I got in early and I gave up early losses, right? So what we have to do is first, we'll see, and that's why, and maybe this will help, Ian, try and really dial it into this criteria, right? So the first thing is like the cheetah, you're gonna stalk, right? You're gonna get into a spot, right? And you're gonna wait. Right. So with the Camarilla pivot points, for instance, let's say we're looking for a reversal off of what we call R4, and I'll get more into that strategy set here in a few minutes. But let's say we're looking near R4, but this works the same off of anything. So let's say you're doing break of high of days, right? Or let's say you're doing the rejection of a break of high of day, which would happen at R4, right? If you're going up towards this level, you're watching this level, right? Agreed, Tracy. Bookmap's very helpful, by the way, if you're having trouble with L2. You're watching R4, but it's not a signal, right? It's not an entry. You don't short ahead of it. You don't short beyond it. What you're waiting for is it to interact with it. Once it interacts for it, you've met criteria 1, right? Where? Okay, I now have a stock that is in a tradable range, right? That's it. That's all pivots give you, or anything like this gives you, is it now allows you to say, okay, the stock is worth evaluating. Until now, the stock didn't required 0% of my time, right? Because the stock isn't even in a range that's worth evaluating yet, right? So I haven't even looked at the stock yet, right? So you sit back. Once it gets into that area, now you can evaluate it. So now you need to evaluate it for a win, right? Is it ready for me to trade, right? And, so if you come into here and you notice it comes up into this range above R4 and then it starts to chop, but you didn't really have a high volume spike as you came into R4. You just kind of stayed level in your volume, right? And it's maybe tapering a titch, right? That's kind of advancing volume, right? So, and if I've done some VPA webinars as well. If you haven't had a chance to dip into volume and price analysis, I'd highly recommend it for this kind of stuff. But there's 3 major volume types: advancing, stopping, and struggling volume, right? And advancing volume is like an ABCD pattern, right? You go like this, you consolidate, and then you go up, right? That's basically a cup and handle ABCD, ascending wedge, flag, whatever you want, right? Well, volume in this instance will push up with it and then decline during that period and then accelerate with it as well. That pattern and volume is advancing, right? So if you come up into this area above R4 and your volume stays consistent, then you still don't have a trade, right? Because you don't have a win, right? You haven't had a trigger, right? So now if you're going to trade it long, right, you're going to be actually waiting, and then all of a sudden you'll see it start to break up, and as it breaks up, it'll come back to R4, and as it comes back to R4, you'll get a volume spike, and we break away, right? And then you take that new high using R4, right? The volume spike lets you know there's an initiation, right? Because here's what happens. Man, there's so much I want to squeeze in here. You guys let me know if I blow past anything on you, because I'm just kind of going crazy here. When we break out or when we move prices, we need no resistance, right? And no resistance happens when everyone agrees on the direction, right? When the bulls and the bears both are on the same side of the coin, the stock moves very, very easily in the price that it's going in. So when you have these new break highs, right, or these new break lows, what's happening is one participant is being invalidated while another participant is being validated, right? So as you make this break, all your bulls that have bought in are now happy, and they start buying more and selling higher, but all your shorts that came in during that time period get stopped out. That stop out allows the momentum for the market maker to swing the price higher, right? So if you start trading when you're in here, you're going to get a lot of chop, right? That's our kill zone. So we actually want to wait for it to reject value and break away, or reject value and break away. So this is what our pivots are for. They give us our where. Right. So the first part we got to understand, though, with this value assertion is, how do we decide which pivot to play and how? All right. So we're going to go to our inside day. So an inside day, basically for our pivot system, is a day where we're expecting the price action to stay inside the pivots. Now, I teach this differently than other trading people who teach pivots, right? Because the way they teach confuses me, because they've chosen their language backwards, and I don't like it. So I changed it. So when we're trading, right, we're going to be looking to trade on an inside day inside the range. That means the cams are very, very wide, right? So let's say yesterday, right, our cams are like this, right? But today you look out and our cams look like this. Oh, whoops. Hold on. Right, our cams look like this. Right, we're going to be calling this an inside day. The reason we're calling this an inside day is because we're going to be looking to play it from here to here and from here to here. The reason why we can do this, exactly, James, the reason why we're going to be doing this, right, is because the range is so wide, right, that we're going to look to play inside the range. Right. This is already, so we already know by looking at a stock in the first second as we glance at it and we look at our, like I have a 30-minute chart up so I can see a few days worth. As I look back across, I immediately look and say, okay, yesterday we were tight. Today we're wide. Right. So I immediately start thinking, okay, I only have a couple of plays I can play. I can play an R3 short. I can play an R4 short. I can play and that's basically it. If I'm opening anywhere in the central range up here, if I'm opening down here, it's the reverse of that. And those are basically my plays, right? I'm going to play the third and fourth levels back in towards value. Back to my original talk, right? With our circles. Right? All I'm going to be worried about is I'm going to be playing that range back into value and back around, but I'm never really expecting to go out here, right? I'm just expecting to stay in here. This strategy is insanely useful on choppy days. When you're trading choppy days, if you are patient enough and just wait for the stock to get away from value, even on the choppiest of days, you can make money playing the top of the range back to the bottom of the range. This is where having a well-established wear away from value helps, right? I don't like playing value in and out for this very, very reason. There's a lot of pivot traders out there who really talk a lot about playing inside value and then playing out. I hate that. Because playing inside value, and I don't teach it that way, and the reason why is because of that. If you're playing inside value out, you're starting here, and you're hoping to go here and then beyond. But there's not enough room there, right? This distance is small. I don't like that, right? I want to play here back to here, so I at least get that distance, but then I have also got the chance of it coming all the way down to here, right? And then going out if it comes back, or maybe, just maybe, it actually continues to break down and I go out the bottom side, right? The potential, right? The potential on trading outside value back into value is significantly higher on an average basis, right? The stock is more likely to revert to its mean over and over again than it is to reject its mean, right? So it's much more likely that we're going to come back to our average price than it is that we're going to reject our average price, right? We're going to go away. We're going to come back. We're going to go away and come back. Guess what? That's 2 times back. Every time it goes away, it comes back, right? But sometimes it goes away and it keeps on going. That's when we're going to play our breakouts. Not necessarily. You play whatever stop is appropriate for that, and that's defined in your how, right? But if you come to R3 and you go over and then you consolidate here, come under and back test, and then go down, right? You're going to play the break using the pivot, right? Or using the new high. right? Or like I like to use new 5-minute highs a lot. So I tend to throw them right there. And then you'll move down that. Now, on a inside day, right, we're going to flip back to this guy here for a second. On an outside day, naturally, we're going to do the opposite, right? We're going to be playing off of the levels and we're going to be going out, right? So let's go micro on this pink guy over here, right? We got our small areas here, right? Now this time, right, our value areas are here, here, and here. This time we're actually planning on going like this and going out. Right. So in this instance, you're going to buy extreme reversals off the bottom levels or breakouts off the top levels. Right. But you're not going to trade inside of this on an outside day because it's an outside day. Right. So you're only going to be trading when you're on the extremes of the range to go out, not back in. Right. And because what's going to happen is, and think about how many stocks we've highlighted in the past few days that have broken out and then just have not looked back. Right. We even have stocks today that did some really nice reversals that did the opposite of that. On these, we're going to be playing primarily the fourth levels. The breakouts and breakdowns happen off the fourth levels. Between 3 and 4 is heavy kill zone. So it's very, very beneficial to just allow it to get outside of range. If it opens outside, let it come back and then buy it or short it as it comes back off of the range. Don't be afraid to let it come back into range and have faith in the system that's going to work. All right, so this is kind of what I'm talking about here. So you notice here how we have this tighter range here. Notice how the stock on this day played outside the range. Where this day we have a slightly wider range, right? And the stock and the SPY actually stayed and played inside. Notice how we had one value area for multiple days. And then look here, R4, we have a breakout day. Look, we open outside R4. We did a breakout and we stayed outside all day. So forming our bias. Now, this is kind of a little bit more nuanced. And you really kind of keep an eye on. It's really important to understand that bias is long-term bias, not short-term bias. All right. So when I say I have a bullish bias, what I mean is that we have a bullish bias overall in the direction of the stock. Even the most bullish of stocks can have pullbacks. Again, this is why we use the cams, right? So if you have a bullish stock, for instance, that's in a bullish position, but your price is opening under R3, right? Then you're actually still going to play it short, even though it's bullish. You're just going to be playing it off of the extension of the range because you're going to play a pullback to S3 and then most likely long off of S3 for a move all the way back up and out, right? So, but you're going to be playing that pullback on the larger trend. So that's why when we form bias, that's not a actionable thing. It's just a bias, right? Opening price, where our price actually opens is what's going to really give us our best concept of what we're looking to do in that day. Bearish bias, same as bullish, just opens below. Most of the time on most days, I actually like going in with basically no bias at all. But if you have a day where your pivots are basically dead even with the prior day's pivots, then it's indecision. So you're at a value area and you can't really have a bias. So in this instance, you'll have to see where it opens and then play the cam range, right? If it's a tight range today and it was a wider range yesterday, then there's a good chance you're going to break out, but you have a lack of bias. So you don't really know which way, right? So you're going to just wait and see, right? And that's the difference between what cams do and a lot of the other strategies and where they fail. So many other strategies, they make the wear too loose on you, right? And they say like even some strategies that seem upwardly simple, like an ABCD or something like that. Your ABCD, it's like you get a high and then it pulls back and then you go long as it breaks and makes the new high. But it really doesn't take any account into like significant resistance levels or like what the order book looks like or all of these different things, right? all we have is just aware, right? And that's all an ABCD pattern is, like a pivot point, right? It's just aware. Now, pivot points are predictive, which I like because they're already there ahead of time. And I'll show you some examples of how well they work today. If I haven't sold you by the end of what I show you at the end of the session, do it. So what I honestly, for ads, James, I would use larger time frame pullbacks, so like major averages. So most algorithms that are, once the stock is in transition, it's more or less in control of by algorithms. Those algorithms will pretty much buy the same MAs as they're moving, right? Or sell them as they're transitioning. So look for the correlating MA, and after it hits it and makes the new high, play the ABCD off of it. And you probably get a good move there, right? That probably works well with you. Yeah, the longer time frame MA, exactly. An ABCD off of one of those, probably gold. I mean, it's going to be real nice. And if it crosses it, then you know you're done. You know what I mean? If you get like like let's say you're doing the greater pullback 20, but your 9 and your 20 cross, right? Then at best you have no momentum, right? So why stay in it? Might as well just cut. And then if it sets back up, get in with fresh risk and use some of your profit. But you don't want to get stuck with your liquidity tied up in some trade that's just going to be sideways for the next 2 hours. You know what I mean? Just get your money and, go get lunch, right? So I've got some cheat sheet areas in here that I'm going to, I'll send a PDF into Mike for you guys on this one if he doesn't have one already. I don't think he does. So on these to kind of show you guys the different judging things that you can go through, because then you can see kind of how these break out. But I'm going to go through some different charts here in a minute just off of my DOS, and then we'll just do some questions here to wrap up. I have this in here, which is a nice cheat sheet for everybody to look at, the different biases range things. So you can go through and analyze that, and it's got the different criteria in it. So here's some trade examples of trades that were taken. You can see that, this one was taken SQ under R3 for a nice breakdown. You can review those when you go through. Here's an S3 long on AMD. This is a central range long, but it bounced off of S3 and the cam range was so tight. The long was at a new 1 minute high and still and was still halfway through the range. Big breakout there though. This is what I was talking about there. R4 breakout. See what I mean about an insight? Look, we got wider day, tight day. We bounced S3, then we made the R4 break. Big run there, right? Short R4, back test would have worked really nice. Hey, does this look familiar to anybody today? That just happened. We're going to look at that today too. That's the main thing I want to look at today. So you can see all of these different instances just to show you guys where they looked through, and I'll have a PDF available on these so y'all can go through and look at them. It's just trade upon trade upon trade of different stuff we've taken. This one was outside of R6, so I played it when it crossed the MA long for at one breakout off of a clear level, and then played a reverse off of the MAs back in. That's a lot live trades. This one was a failure from R6 on Facebook, just for a little extended. This one just showing you a nice R4 breakout. So let's I want to go through a couple more things for you guys before we do some questions and close this out since we got 15 minutes. So I want to check this out. There's a stock today that was 100% the best example of this I've ever seen, and it was the SPY. The SPY is a perfect example of the cams working really, really, really well. I would like to offer you one of the tightest indicators I'm capable of giving anybody at any time. Right? So we start off the day correlating heavily with S3. Right, we come right into it. We peg S3. We open up and we break and we go north. We run right into R3. There you go. Right. Really nice. We had a nice tight inside push. We came off the opening price off of S3. We traversed right to R3 through an upside down hammer on high volume. That's a VPA exit signal for sure. Everybody went short. I mean, I think we had like maybe a dozen people in the chat room when I called this went short off of this. I got a lot of really cool emails, right? And then boom, right? Can you trust the cam levels to be precise? Not generically, Tracy. I'll be honest with you. I don't trust anything during the open auction, but it was precise as all get out. Now on the SPY gets very, 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 very precise to cams during these open auction periods. So I've seen SPY hit like this multiple times. So on SPY, maybe, but for the most part, I would never trust anything to hold. But once it bottomed and set that low, you easily could have thrown an order underneath it and just took S3, right? But you would have let it come down, bounce it, and go long. It's not a good RVR, which is why I wouldn't have taken it. I would have waited for this short at R3. Having it open at S3 like this and run, I immediately would have looked for a short at R3, and I called it. I was just already kind of done for the day. So, and the reason why was because of this guy, right? And this is what I'm talking about as far as our extension in range, right? When you're trading, a lot of us don't do well because how do I say this? Okay. There's a little bit of a cultural, from my perspective, and this is my humble opinion, obviously, there is a cultural issue around day trading where because it's day trading, we think it's fast, right? Now, we are restricted by time, but it's not fast. It's precise. Right. And I think that's the distinction maybe for everyone who's having trouble waiting for your trade. Maybe that's the mental distinction you can attempt to make for yourself. It's not fast. It's precise. Like I started out with at the beginning, like the cheetah, you've really only got so many attempts before you're going to be exhausted. For you, it's financially. For them, it's their energy. But if they don't score, they go hungry. And in the same way, so do you. So if you're just jumping and pouncing anytime anything catches your eye, you know, you're just going to miss over and over again, right? Trading is intentional, right? That's why you need a where, when, and a how. You need to know everything. So in this trade, let me detail how it looked to me. So the first thing is we go wrong is we're trading the open. Trading the open, especially for a newer trader, if you would like, I would be more than happy to give you my my PayPal, and you can just start sending me $100 a day. I'll just put it in there. Leave it there, and in like a month, I'll just give you like 80% of it back and keep 20% as a holding fee. It'll be a nice way for you to keep some of your money. It'll be a lot more profitable than just trading the open as a novice trader. I promise you. And the reason why is this. And this is the cultural issue I'm talking about, kind of just in day trading. We're obsessed with trying to trade from here to here. Why would you do that? The move is from here to here. You know, that move. Right? This move was calculated, right? This move I saw struggling, high climactic volume, high value area established, tested VWAP, indecision, R4, under R4, holding under R4, indecision, level 2, balance to the downside, bids loading at 58, right? Bids loading at 57, bids loading at 58.50, right? Short at the break, right? Lost, made a new low, lost VWAP, short, new 1 minute high, right? Or R4, right? Partial faster than I could think, right? That drop took about a half a second, right? I clicked the short button, looked down and saw $300, right? That's how fast that went. I took $100 risk. By the time I looked down at my P&L, it was already at 300. That's how fast that dropped, right? Partial, right? And if you time those trades right and you wait for those break points, it's like a cheetah, right? But this was not a fast trade, right? Where, when, how, methodically thought of, precise. I have 2 years, maybe 2.5 years of hard research and work put in to this R4 rejection. Basically a head and shoulders, right? Over on R4. Years of work I've put into being able to push the trigger at that point in time, right? So, and that's what you're going to need to do, right? You're going to need to practice and take time, and it's not going to come fast, right? It's going to come after arduous work, but like the cheetah, you need to be intentional. You need to take the time to really understand why you're doing what you're doing, right? No, not really. There's no ATR calculation in CAMs. But ATR maybe hit around where CAMs hit. I'm not entirely sure, to be honest, Miguel. The thing is for me, like, I'm never really worried about ATR. And I'll tell you why. Because let's say ATR or the trading range, right, is this much to this much, right? If we're outside of the ATR, we're breaking out, right? So as far as I'm concerned, being outside the ATR means ATR has no value anymore, right? Because I'm outside of it. So we've broken out. Does it go back inside? Maybe. Does it go outside? Maybe, right? There's no way to really know. What's important is RVOL, right? If you have 180% RVOL and you're outside of the trading range, then you're Oxy, right? You're Twitter, you're breaking out. And on these kind of stocks, and it just depends on what types of stocks you play. Now, if you're more like Eamon, right, where you don't really, Eamon doesn't play catalyst stocks. He doesn't play news. Eamon plays complete daily charts and ranges, right? So Eamon and obviously is going to be a little bit different here for him because he's playing low volume, right? And he's playing stocks that aren't in participation or in play. ATR is more relevant for him because he's going to just use the average amount of that the stock uses when it's not in play. But, that's really hard to really have provide consistent results for me, at least. I've looked at that. I just had a lot of trouble getting that to perform day to day. I would see that kind of stuff work some days extremely well, but on the majority of days would just kind of at best be level, at worst extreme losses. Do you ever question the move when the price starts to consolidate around a daily level? Sure. I'm always questioning the move, Tracy. Every single second I'm reevaluating. Here's something I like to ask myself. I like to say to myself this, and I do it as I'm trading throughout the thing, because what I'm concerned about, of course, Miguel, what I'm concerned about is the market makers, right? So my question that I always ask myself is, what are they doing? Why are they doing it? And how well are they doing? Right? So, okay, I'm thinking about taking a partial here. What are they trying to do? Why? How? How are they doing? Okay, what? Okay, the level 2 is very imbalanced to the downside. I see large orders at 50, like, arbitrary, $54. All right, why are they getting there? Or, why? How good of a job are they doing? Okay, not very well. We don't have a lot of volume. They're struggling. We have sellers coming in. Okay, they're not doing well. I'm going to take a partial. Right? These are the kinds of things I'm looking at because, again, you'll see what you saw on Oxy happen. Right? You'll have a large order that's sitting up here, right, on the level 2, huge orders. But as the price goes towards the orders, it stalls, turns over, and then runs away rapidly. And you go, what? I thought you were going to go there. Well, the problem was we didn't have any orders above. Right? So when you asked yourself, how are they doing? Your answer would have been poorly, right? Because the bulls, right, are already out, right? You see, when there's no orders up above on the ladder, there's nowhere for the price to go. When you're looking at your level 2, you got to think about ladder like rungs on a ladder. And if you don't have those rungs, you can't climb, right? So as you're climbing, it's basically getting to the top of the ladder. You're going to reach, but there's nowhere to reach, right? So you're going to start climbing down the ladder the other direction, right? And then what you'll notice is when that happens, sure enough, on the level 2, you've got rungs headed the other direction, imbalance to the downside. If you have balance on both sides, the price won't go anywhere. It'll just ping pong back and forth between the orders on the book because we have balance, right? And we'll just stay in value and chop, right? Until we have obvious imbalance in one direction or the other, and then the market maker starts to run. But if the market maker is trying to advance and break through this high level here, no orders above means you've got no bulls, right? Last distinction, and then we'll call this thing. There are a lot of stock programs out there that teach day trading wrong, okay? They teach day trading the way they teach long-term or swing trading, and the rules are different here, right? We're restricted by time, not by price, right? We get out when we want, we get in when we want. We're day traders. We don't have to hold all day, so we don't care if it goes against us 5%, 10%, or whatever. Once it goes against us anything, we're out, right? And we have that ability, right? Which is great. But when swing traders teach level 2, what they will teach you is that large orders act as resistance, right? So they will teach you not to trade into them, right? But that's because they're worried about the price rejecting intraday and closing lower at the end of the day. We're not worried about that, right? We're worried about, will it get there today? How close will it get, right? So if you have a bullish ladder, you go long, right? Because you're going to get that money. And then when your ladder runs out, you take your profit off and you get out. But remember, if there's no ladder to the top side, that means your bulls are out. Once it starts to make those new lows, your bears will come in and your bulls will start taking profit. And this closes out. The strongest moves happen when you have unidirectional market sentiment, right? So once that, think Oxy today, think SPY off of R3. When one set of participants realizes they're wrong and the other set of participants realizes they're wrong, everything goes really fun, right? Because what happens is the bulls start to sell and the bears pounce and you get this big, big dramatic move. These are the moments where you get the most profit. And guess what? That moment cannot set up during the opening range. In order for people to be right and for people to be wrong, you have to allow enough time for participation to come into the market, right? Any trade that you take in the first 4 or 5 minutes is straight up gambling. I take them all the time. I'm not discouraging you not to gamble. I'm just being very honest about the type of trading you're taking there. It's a high octane, high risk, low probability, low profit probability trade. The best trades with the highest probability will be trades 15, half hour, 3 hours into the day, right? After the stock has had a chance to get to some extremity in value, accept value, and then reject. that rejection play, that acceptance and then rejection play, whether that's to the long side or to the short side, R4 breakout, S4 breakdown, traverse back across, whatever it is, that move is going to be the best opportunities you get throughout the day. So don't exhaust yourself trying to blow out your bank in the first few minutes. I promise you, if you take the time and go through the charts, virtually every single chart trades better a few minutes in, right? Has better, longer, more manageable moves a little into your day. If you're a novice trader, don't start surfing the big waves, right? Start surfing the waves that you can manage, right? And then at some point, maybe we become Andrew, right? But for now, we stay humble, right? And control the one thing that you have to control in the stock market. When you get in and when you get out. That's the only thing you have control of. So use that power, right? Use that power and only get in when you really feel like it's worth your time. So I hope everyone had a great evening tonight. I appreciate your time being with me. A little bit of fun, a little something different. I will talk to you all a little bit later. Peace out, everybody. Thanks.